Seasonality is the phenomenon typical for most of commodity markets. For example, the heating oil is more expensive in winter because we need it for heating, and logically, it's cheaper in summer. Similarly, gold is more expensive in autumn due to increased demand of jewelry before Christmas. This kind of annual seasonality can be found in most of commodity markets. Thus, the seasonal annual price increase of commodities is much more predictable than price movements of stocks or indexes. And therefore, the probability of making profit from seasonal commodity trading is much higher. In certain cases, the seasonality principle may get even multiplied when trading two commodities at the same time, each of them with strong seasonal movements. Let's imagine it's late spring now. We can buy a contract of corn where we expect a seasonal price increase during the month of May. At the same time, we can sell the contract of wheat where we expect a seasonal price decline. Our interest is to make profit when the price difference, so-called spread, between the two commodities increases. This method is known as commodity spread trading. We are using the principle of so-called covered positions. It means that the risk from buying corn gets covered and minimized by selling wheat at the same time. It also means that buying one commodity and simultaneously selling another one minimizes an exposure of these commodities to fundamentals. Let's demonstrate it on a simple example. A flood, which comes in mid-May, will affect a crop of grains and will cause a lack of grains on the market. As a subsequence, this will result in higher market prices of grains. However, in our case, the flood will affect both corn and wheat in the same way, and therefore its impact on our trade will get neutralized up to a certain level, of course. Till this date, during the first half of May, the seasonality worked in our favor as expected. The price of corn was rising and the price of wheat was declining, and the spread between the prices of these two commodities kept growing. In mid-May, the flood came and it affected the market prices of both of our commodities. The expected price of wheat started rising, and at the same time the price of corn got much higher than foreseen. You can notice that if we only traded wheat on its own, we would start losing our money as the seasonality didn't work due to unexpected flood. However, in our case of spread trading, the price difference between the two commodities remained the same because the flood affected both commodities in a similar way. Therefore, the commodity spread trading is considered much less risky than standard trading. Let's have a look at a practical example. This is the chart of a spread. It means the chart of the price difference between the contract of soybean meal with delivery in July and a contract of a soybean meal with delivery in August. In other words, we would buy a contract of July soybean meal and at the same time we would sell the contract of the August soybean meal. You can immediately see on the chart that during past 20 years there was a strong seasonality between the 7th of May and the 8th of June. The red curve represents the historical average of prices of past 5 years. The green curve represents the market price average of last 10 years. The blue curve represents 15 years and the orange curve represents 20 years. And of course the black curve, this is our current year spread. As you can notice, there is a strong correlation between these historical patterns. Such a strong seasonality substantially increases the level of probability that in the current year there will be a strong seasonal movement as well. We can even check the level of seasonal correlation in these tables. Here it's possible to check the level of correlation amongst the historical patterns. You can see it's really high. And here we can see the correlation between the current year's spread and the historical patterns. This kind of situation significantly increases the probability that this correlation and seasonal trending will continue also between the 7th of May and the 8th of June of the current year. Let's have a look at the results of this strategy in past years. We can see that in past 5 years, this trade was profitable in each year in case that we opened the trading position on the 7th of May and we closed it on the 8th of June. Looking at 10 years back, there was only a single year when the seasonality didn't happen. During past 5 years, there was an average profit of $414 per contract. This profit was made in 33 calendar days. It means that this year we can expect to get a similar profit from this trade. Let's now watch the development of this spread in year 2015. This year the spread perfectly followed the seasonal trending, and it resulted in a profit of $480 per contract. Would you like to learn how to profit from seasonality with minimized trading risks? Take part in our courses of commodity spread trading. We provide a series of 3-day course in which you will learn all you need to know to start with live and successful trading. The graduates of our courses start with profitable trades within 3 to 6 months from completion of our courses. Would you like to know more before taking our course? Join the free webinar and learn the basics of commodity spread trading, or watch the recording of the archived webinar session. Are you afraid that you would not be able to trade on your own? No problem. You can follow our bi-weekly analysis of current commodity markets. There are 3 steps to successful seasonal trading. Learn commodity spread trading with us in 3 days. Start with live trading within 3 to 6 months from the course completion. And increase your trading capital by 0.1% per year. We are looking forward to meeting you in our courses.